you, everyone. Good afternoon. Hi, how are we all doing? Good? Okay. Thank you so much for taking our time to be here. I'd like to say that this session is dedicated to female founders and founders-to-be. Are they in the house? Please wave. If you're standing and you're a woman, please find a seat. There are seats around here, and I can see empty seats around here. So please feel free to sit down and relax. My name is Damilola Teidi, and I lead the platform and networks team at Ventures Platform. And simply, this is a team focused on post-investment support. Next slide, please. Right, so who are we at Ventures Platform? We're a leading early-stage Pan-African fund that invests in startups led by mission-driven entrepreneurs who are building market-creating innovation. So innovation that create access and create new markets. Now, what you need to know are the things I've put there in bullet points. We invest in pre-seed to pre-series A, so from very early stage to later stage. Our ticket size, we can do as low as 100,000, we can do as high as $1 million. We're capable of leading a round, so we can come in and take a huge chunk of the round and invest. And then we can do follow-on investments. So we can invest in you now, and as you grow, we keep investing in you. We've invested in over 70 tech companies, some of them that you know. Fez Deliveries here, Paystack, PiggyVest, MyCover, who has their stand, Sunfi, Traction, quite a lot. Reliance HMO, some that you use. And, you know, would love to add more women to our portfolio. And that's why we're doing this session. So we also provide valuable support beyond the capital. So aside just giving you capital, we're able to provide valuable support to you. Now, we all know that there's a lot of funding that has come into the country, but there are not a lot of female founders that get access to this funding. And that's one of the reasons we are doing this particular session, is that one, if you're a female founder here, and that you're currently raising money, looking for capital, or about to start, that you leave here with practical insights, tips, tricks, best practices for you to be able to put yourself forward in the best way possible. Can I hear an amen, everybody? Awesome. And then the second thing is, if you're a female founder to be, that means you're thinking, boy, yeah, I should enter into this startup, or boy, yeah, I shouldn't. This would be a good time for you to learn one of the key aspects of building a startup, which is fundraising. What should I do? So that it can also inform the kind of startup that you may want to build or how you approach building it. Another amen? Awesome. So whilst we go, I have amazing speakers today, and I'm going to call them on stage. This is the link to ask questions, so you can just scan the QR code. We will take questions after key presentations by our amazing speakers, and they'll be touching on key fundraising topics. So we have today Seun Ale, CEO and co-founder of Fez Delivery, powerful logistics network. Any delivery that you want, Fez Delivery, if you're a business and you're not using her today, I'm sorry for you. Please sit down. We have Odunayo Eweniyi, co-founder of PiggyVest. Everybody here is using PiggyVest. And Fez Check Africa. Please welcome her to the stage. And then we have Dolapo Morgan, my amazing colleague, Senior Investment Associate at Ventures Platform. Seun will be talking about the preparation stage before you fundraise. Dolapo will be talking about what VCs look out for, you know, beyond just the easy pitch deck. What are the other details? And Odunayo will be talking about capital efficiency, because as we are now, funding is reducing small, but we're still going to get it for female founders. And she's going to tell us how we can be efficient with the capital we get, but also how we can show investors that we're capital efficient. So not to take too much of our time, I'd like to call on the podium Seun Ale, CEO, co-founder, Fez. Next slide, please.
Thank you very much, Damilola. Good afternoon, everyone. My name is Seun Ale, and I am the co-founder and CEO at Fez Delivery. Last year, and Dami has given me a very huge task to summarize 8 months into 8 minutes. I'll try my best. So, We are a logistic company, like Shirali said, and we are leveraging technology for efficiency. We help people move items from point A to B. And at a point last year, we realized that we were leaving a lot of money on the table. What do I mean by this? That at every point in time where customers reach out to us, we turn them down and tell them we are not able to fulfill your logistic needs because we were oversubscribed. And we were fulfilling maybe less than 70% of the orders that came every day because we didn't have the capacity to meet these demands. It was at this point that we realized that we needed to, because again, we have a vision to reach a larger audience. We don't want, after spending a lot of, talking to people, getting referrals, we didn't want people to come to us and we have any reason to turn them away. They would go and probably never come back. It was at this point we realized that we needed to get more money, scale up our operations so that we can attend to all the market segments that we have decided to serve. Next slide. Next, previous slide. Yes. So that was our own experience at first. It could be different from you. Like if I rightly mentioned where she was speaking, fundraising is not one size fits all. It's different from companies to companies. But one thing that you need to be very sure of before you start thinking of raising funds is that you should have a clear vision of what your company is about. Like how big do you want to be? What problem do you want to solve? It has to be very clear to you such that you can convince people to come on the journey with you. Secondly, is it that you have launched a business? You have launched a business or you have gained traction. For us at first, we had bootstrapped for 3 years, and we wanted to go bigger, but we did not have the resources to go bigger. It was at this point we also decided to start speaking to investors. Next slide. How do you determine your fundraising needs? Funding needs. You have to be very clear on what your revenue costs are and what are your revenue costs. And every cost that you incur to get your items delivered to your customers or to get your customers served, depending on what kind of business or product that you sell. You have to weigh your capital cost as well. What do I need? For us, it was assets. We wanted to get more assets. You also want to know what your project cost will be. Do you want to expand to new markets? Do you want to even expand within your current market? You also have to get your projections right. And I would advise, if you're unable to do this by yourself, outsource it. You don't have to do it by yourself. Your projections have to be true. Like, what are the plans? What can we make of this business in the next 3 years? What can we make of this business for the next 5 years? Where do we see ourselves in the next 5 years? Some companies can even go as far as 10 years. For us at first, it was projections for 3 years and 5 years. Next slide. How do you craft your fundraising strategy? You need to ask a lot of questions and be true to yourself and to your company. How much revenue do you currently make? For those that have launched already, how much money do you make? How big can your business get? And success is different the definition of success is different to everyone. Someone, Yabara Katu sells at the junction is successful because she sells out every day. And that's success to her. For you as a business, you just want to play and just earn a need, or do you want to reach out to more people? That has to be very, very clear to you as well. What's your company's current worth? And this is a major issue this is one of the issues that causes back and forth between founders and investors. How your company is valued. And I saw something on the internet yesterday where someone said, your business is still at an idea stage and your valuation is $100 million. How do you value the company? For us, it was that if we paid off all our debts and sold out all our assets, how much money did we have at that time? That was how we valued our company. And how much equity we were willing to give. At every stage of investment, fundraising, you lose some money. You don't lose in quote now, you give something out in form of equity. And how long do you have to raise the money? You don't want to stay too much going back and forth with your investors because there were so many things that you did not define before starting the journey. You get to a point where there's either the investors' fatigue or the fatigue on you as a founder. So you want to be clear on how long you want that fundraising to drag for. I don't know, maybe investors will advise us, but as a founder, I didn't want it to exceed 2 months, and we did it within that short time. Next slide. Another thing you need to look at is you need to conduct a SWOT analysis. What are the strengths and weaknesses of the business, and what are the opportunities and threats that you see as well? And do everything possible to minimize or eliminate the weaknesses before you start talking to investors. Investors are human beings as well, but and all you just need to show them is we've identified these weaknesses. And I think it was Keturah that mentioned that she had 100 items on her list of why her business could fail. You want to show the investors that you know what your weaknesses are, you've worked on eliminating some, and they can work with you on the journey to eliminating others completely. List out the investors you want to pitch to, speak to portfolio companies of those investors, for us, it was speaking to people. So we had like 100 names initially. I worked with some friends, support systems, and we brought it down to 6. Odwaya was one of the 6 people we spoke to. 2 gave us, 2 rejected us, and 4 took us on. So you also want to it's good to have a lot of names, but you want to create a matrix of eliminating those names, those investors' names, so that you have a short period of time to speak to all these investors, and you want to reduce your list as much as possible, just so that you can speak to everyone. Yes, next slide. That's it. Thank you.
Another round of applause. When we met Shewan, as we also invested in Shewan, it's very interesting to see all the things she had done because it actually reflected when we were doing the due diligence. Everyone, all the workers, customers had good things to say. And it was also clear that she had looked at all the weaknesses and we knew where we could apply supports. So Shewan is one of the amazing founders that we have. Now we're going to move to the next stage. So what Shewan has done has talked about how do you prepare for fundraising. Now the next stage, we will hear from Dolapo, who is on the VC side of things. And she's going to be talking about crafting your pitch, understanding what VCs look out for. Now, I'm sure you've read so many books and all of that, but why this session is special is we're going to use ourselves as a case study and be able to show you examples of things that, okay, if you're pitching to a VC, you need to understand this so that you are positioning yourself right? And so I'm going to call on Dolapo Morgan. Please give her a round of applause. Senior Investment Associate at Ventures Platform.
Hi, everyone. Really nice to be here today and see so many women. Dami mentioned that one of the reasons that we're having this event is that we want to back more women. And so it's really nice to see all the faces here today. So I'll be speaking on 2 main things. So first of all is what are the components of an ideal pitch deck? And secondly would be what other criteria do we look out when we're reviewing startups. So next slide, please. So there are about 8 key components of a pitch. First is the problem. This is really critical, and I always say that you should be speaking to investors like they're 10-year-olds because we don't necessarily have expertise in different sectors of the market. So it's important to articulate your problem in a very clear and succinct manner. Next is your solution, and I often like seeing when it's like a one-line, sexy statement that summarizes what you do, and being able to break that down into the different products that you have in a very clear manner. The third thing is the market, and this is so important. We really want to back founders in huge markets because that's really how we make money and get the returns from our investment. So being able to show what the market size is, what the potential would be in the future, which would be shown through, let's say, the growth rates of that market. Next is the business model, and this is essentially how do you make money. And I think this should be said very, very clearly and very simply. So if it's, a percentage of certain fees or a particular fixed fee, but it's important for it to be clearly stated and showing the different revenue streams that you have. Next is your traction. I'll say this is one of the top slides that we would spend a lot of time looking at. We want to see that the founders have already started putting in effort. Even though we're early stage founders, I think in this climate, it's really important to show some progress being made. And so even if you're a pre-revenue startup, you can show things like users, just other metrics that show that you're making progress. And if you're post-revenue, you show your revenue. We like to see what your growth looks like on a monthly basis. The magic number people argue is about 15 to 20% as your monthly growth rate. And annually, I would say in a country like Nigeria where there's high inflation, there's currency devaluation, for you to even grow, you need to definitely grow at least by 50% for you to even see any type of growth. So those are the things you should think about when you're showing your traction. Next is competitors. So obviously, you think you're the best founder, but we want to also see what else is going in the market. And it shows that you're very realistic if you're able to break down, okay, this is what my company offers, but these are what my competitors are doing, and this is what I'm doing maybe better than them. It shows us that you have a good understanding of the market. You have a clear idea of how you can potentially win. Next is your team. I think this is also the second most important slide. At the end of the day, with early stage investing, we're really backing people. And so we want to see people that maybe potentially have a track record in this field, or even if just showing that you've done some things that show that if we back you, you're able to execute. Another important factor is we were speaking to some Series A investors last week, Partech actually, and the way they look at the team is very different from the way we would look at it at pre-seed or seed stage. Ours is very much, do we believe this team can raise Series A? And for you to be able to raise Series A, you need to be audacious. You need to be a good storyteller. You need to be a good salesperson. And you could hire someone that can do that for you. But when you're pitching to investors, it's actually the founding team. So even if that's not a skill that you naturally have, it's important to actually train yourself to be a good storyteller, because the bar for Series A is a lot more competitive, and they're a lot stricter than, pre-seed or seed founders. And next, I'll be talking around what factors influence our decision-making beyond those 8 key points. So first is thesis alignment. I think it's important for founders to, before you approach investors, is to look at what their thesis is. And this varies actually per company. Our thesis at Ventures platform, like Dami mentioned, is market creating innovation for non-consumption. This essentially means that we want to back founders that are either solving for markets that have previously been untapped or are almost creating new markets. And so when we're assessing a deal, we're thinking, does this fit with MCI? And we may actually say no just because of that reason, not because the founder isn't great or they haven't made good progress. So that's important. Next thing is portfolio construction. Here is that we essentially can't back people that are doing the exact same thing, because we're almost enabling competitors compete. And so it's important to look on the websites of your VCs that you're approaching to see what other companies do they have when you're approaching them. The next is the ability to raise follow-on rounds and exit potential. Here, I'll speak, maybe focus on exit potential. I think a lot of people sometimes might forget that we only make money if we see that the businesses are able to make follow-on rounds, or there's some form of exit, which might be through an IPO, it could be through an acquisition, or it could be through secondaries, which is essentially another investor buying out the shares that you currently have. And so that's another criteria. We're thinking, okay, are our Series B investors that we frequently communicate with willing to invest in this type of company. And last and most importantly is the ability to return a significant proportion of the fund. So we're essentially a approximately $50 million fund. And how we think about this is that if we're investing in a company and let's say our target ownership ranges from 5 to 10%, so let's say we take 10% of a company, in 5 years' time, what we're expecting is that that business should be making anything between 10 million in revenue to 100 million for us to even return just the fund amount. And so if you think about it, we have LPs that have invested in our companies, and they have the option to invest in other form of, whether it's the stock market. So they don't want just to get the 50 million that they invested, they want more. And so if you think about it, the bar is quite high, and you must be solving really in a huge market for you to even potentially get minimum of, let's say, $10 million at exit. So those are some of the key things that we look out for, and look forward to speaking to some of you after the session. Thank you.
Thank you. Amazing. Please give her another round of applause. Did you get some nuggets there? Yeah? I think what is most important that she said is sometimes people approach investors from I'm doing something really nice, I'm doing something really good, give me money because I'm making some kind of impact. But it's always important to put yourself in the investor's shoes and say, these people, where did they get the money from? It didn't grow from trees. They're going to return back the money. And so investors are looking at you as to, will you be able to add to the returns that we have to give back to our own investors? So sometimes when you meet different founders, you imagine that they are not thinking about that, right? And there's something what we call VC backable, right? There are some companies that it's not VC funding that you're supposed to raise. And it's okay. You build a good business, you make constant revenue, you are making profit, it's okay. There are some businesses that are VC backable, which means the 10 million she's talking about, the 100 million, the way your business is set up, you've seen that it can make those kinds of returns. You can get VC funding to be able to push that. So it's always good to keep that in mind. Please give her another round of applause. Thank you. So last but not the least, and we will go to questions. Can you quickly go to the second page, the one with the question QR code, very quickly, please. Just go back a bit, a few slides back, please. Yes, thank you. Again, if you have questions, please scan the QR code, use the link, and send in your questions. We won't be able to pass around the mics, so I'll be the one to take the questions. That's why I'm making this announcement again. Now let's go to the last topic, and I'd like to call on Odunayo Eweniyi, who is the CEO, co-founder, PiggyVest, so she's a founder, but she's also an investor of VCinAfrica.
Hi, everyone. Can you hear me? Awesome. It's okay. Everybody can see me, right? I have bad luck with podiums on account of the height. But yeah, okay. So, my name is Odunayo. I'm co-founder and CEO at PiggyVest, and I'm also co-founder and general partner at VCinAfrica. I have worked in this tech space for about 10 years, and as the co-founder of PiggyVest for about 7 years. I feel very good about being the poster girl for constantly talking about capital efficiency, mostly because we had, I've told this story many times, a really tough fundraising journey at Seed. And so we raised $1.1 million in 2018 and haven't raised since then. So this is a particularly interesting topic for me. I will try to condense it into 8 minutes, and I hope you can follow along. One thing to say is that I think this is a really topical conversation just because of where the market is today. In 2021, we had several unicorns. Everyone was raising at $500 million. You could get into pre-seed and raise at $10 million. Today, all we are hearing about is valuation markdowns. Everyone's marking down their valuation. Pre-seed valuations have returned to $2 million, $2.5 million. And that's indicative of something. We are all returning to first principle. We are all going back to where the numbers have to make sense. We're all going back to the core of what it is to run a startup. You must make money. To the core of what it is to run a VC backable startup, you must make money in multiples. Now, what is capital efficiency? there's this dictionary definition that I got. I will read it out and then promptly abandon it. Capital efficiency refers to the ability of a tech startup to efficiently and effectively utilize its financial resources to generate maximum output or generate value with minimum funding. In other words, how efficiently can a company deploy its capital to achieve its desired goals, right? But basically speaking, it just means what can you do with very little money, right? There is no two ways about it. Capital efficiency just means stretching $1 further than it would normally go, stretching it to get the value that $5 would create for you. And the second question is, why do you need to be, capital efficient? The reason you need to be capital efficient is because, one, we as Nigerian founders, we as African founders are building in one of the most unpredictable markets that has ever existed. There is no infrastructure here. There is no ready-made market. Ventures platform says market creating innovations. I'd argue that most businesses in Nigeria are market creating innovations on account of you having to actually create the value for yourself before you even begin to build. So why do you need to be capital efficient? The second reason is because funding just doesn't flow to African founders the way that it flows to Western founders. And the third thing is just because it makes sense, right? If you're running a business, the ideal thing for you as a business owner, as a CEO, COO, CFO, CTO, is to want to stretch your resources as far as they can go to be able to get optimum and maximum value from them. Next slide. Now, what does a capital efficient business look like? I will talk about go-to-market strategies, but I think that we all have to kind of understand what the core of it looks like. A capital efficient company is one with lean operations, right? A capital efficient company is one that's learned and figured out its organic marketing principles. A capital efficient company is one that has defined its core target market. Now, in 2017, we went to an accelerator program called Village Capital. And Village Capital has something that we call the viral pathway that divides your pitch deck into 9 and then takes it one after the other. As a company with minimal funding, as a company just starting out, as a company who's raised less than you thought you would raise, or as a company who has to raise a bridge round, or as a company who's now found itself in this really unpredictable market where you don't know when your next funding round is coming, you need to go back to the drawing board on those 9 things. Now, Dolapo already spoke on those 9 things, but the first thing I wanted to talk about is your well-defined market. The biggest problem for companies is overspending on acquiring users. And why do you overspend on acquiring users? It's because you've not defined your target market. And I'll use an example of PiggyVest. When we started, we'd already said to everyone, we are building a different savings system for young Nigerians. Right? We are building it for ourselves as millennials, and we are building it for the people that come after us. And that's what we did. Today, everyone uses PiggyVest, even people who are older than 60. But at its core, it was built for a particular market. Now, if we'd come out and we'd gotten some really dodgy advice about everyone is your customer at the beginning, if we'd come out and decided we are talking to everybody, then we wouldn't have been able to leverage Twitter as the marketing tool for PiggyVest in its first 1 year. Because what we essentially did was we got the idea from Twitter, and then we went back to Twitter and we told everyone, hey, so this is a digital wooden box, how about you use it? But we weren't talking to everybody. We're talking to the average Twitter user. We're talking to the new Covenant University graduate, the new Unilag graduate, the person who's most likely to download a financial services app on their phone and test it. Who is your own well-defined target market? That person is who you spend the lowest amount trying to get onto your platform. That's capital efficiency. Now, effective marketing channels. When you find that person who is your well-defined target market and target audience, where are they, right? For us, they were on Twitter. For a company like Sabi, they are completely offline. For your business, they could be anywhere else. Where are they? Do you know where they are? Do you know enough about the market segment that you are trying to serve to go meet them there, to communicate with them effectively and efficiently so that you don't spend that extra dollar to convince them to use your product? Because marketing for many people is ads, it's ads, it's billboards, it's lampposts, and those are not bad marketing strategies. But they're only good when you are using those things on top of a solid foundation. That foundation looks like a well-defined target audience with a well-defined marketing tool to reach that audience. Conversion optimization. This is really easy once you've done like the first two things. If you've defined the person you're talking to and you know where they are, then you know what they want to hear, right? This is essentially, look, capital efficiency is building the right customer persona, finding them, and then selling to them. When you have those three like checkboxes checked, you don't spend money. The example is still Piggyvest. When we started, we found our people on Twitter and Facebook and Instagram and started talking to them. I actually managed our social media for the first 2.5 years. We used a lot of memes, a lot of GIFs, and we crafted a customer voice. Essentially, our social media voice was, we are not like your boss. We are not better than you. We are your friend who just happens to know a little bit more about money. We went to market with that, and up until 2021, Piggyvest was an organic company. It grew organically. The people joined the conversation because they were included. Now, okay, so I think I already gave an example of low-cost strategies in real life. Next slide. Now, if you are a pre-seed company, now you know that we're in a rough market, right? If you were raising $1 million before, you're probably closing at $500,000. If you're raising $5 million, you're closing at $1 million. You've raised some money. Now, your problem is, how do I make this money stretch? I have some experience in making very little money stretch. So, what are the things you need to do? Hiring and personnel. This is very hard advice to balance because one, you don't skimp on the people, but two, you don't hire too much, right? So at the beginning stages of your business, the kind of hiring that you need to be doing is generalist hiring. You need to hire people who can stretch, people who can cover more than one topic, people who can do more than one thing, right? For the first, I don't know how many years, Piggyvest was an exact team of 12 people. Now today, Piggyvest is an exact team of 150 people, but that switch happened only when we hit break-even and then profitability. For the first few years of the business, we were a very lean, very efficient machine. And we were very, very particular about the people that we were bringing on board. Hire the best people, hire efficient people, hire people who believe in your vision, but most importantly, hire people who know more than one thing. Hire people whose skills translate, whose experiences translate in such a way that you don't fill your company with people, you fill your company with people who can automate, people who can build systems that other people can then fit into when your company reaches sustainability. The second thing is organizational structure. From hiring and personnel, you come right here. Lean teams, remote hybrid work. This is a very interesting argument, so I will not get into it. But basically, the structure matters. What the people who work in your company do matters. How they work matters. How they communicate matters. And finally, your company culture matters. If everybody who works in your company isn't trying to save you money, your company is not capital efficient. If everybody who works in your company doesn't understand what the tenets and the basic principles of your company are, then they cannot help you be capital efficient. And finally, utilization of invested capital. Like Dami mentioned, I wear two hats. I'm a founder and I'm an investor. And on both sides, there is nothing that sends a red flag to investors or even to fellow founders more than wasting invested capital. One of the things you can do, strict budgeting. You run your company the way you would run your own personal finances. Okay, no, don't do that. We don't run our finances well. I don't know, you run your company the way you would run a company. Budget very strictly. Don't overspend. There is boundary lines between departments. Make sure that every dollar is accounted for, but beyond being accounted for, every dollar is bringing in value. And secondly, audits, right? The only way to verify and validate your budgeting efforts is by audit. So I think that was 8 minutes. I hope I've been able to condense a bunch of the points into this, but thank you.
Please, can you give the powerful women on stage a round of applause? I hope you've been sending your questions, because right now we'll take a couple of questions. I'm just going to move to where I have questions. But thank you, Odunayo, for that. I think just a quick example of what's happening, right, is that there's a company last year that raised, let's say, $5 million. They had closed and announced that they raised $5 million. They had planned with $5 million. So $5 million would take them 18 months. Two of their biggest investors did not send the money. So this economic wahala that is happening to everybody is happening everywhere. They didn't send the money. So imagine receiving $2 million when you had planned with $5 million. Everything had to be stripped off, right? So capital efficiency, that's why we added it to this session, is very important, right? Because you can raise the money. What if somebody says, oh, sorry, the person that was owing me did not give me the money, but you didn't tell me somebody was owing you now. What's going on? So it's very important to be capital efficient. Now, I'll take a few questions. I think the first one is to Sheung. We've been talking about investors, and you mentioned a list of investors. If there are people here that don't have the connection to investors, what do they do? How do they get that connection? How do they get to meet investors? So you can take it, and Odunayo, if you want to add to it.
Okay, thank you very much, Dami. So if you do not have a list by yourself, I'm sure you have friends. You have a network of friends, of other founders. I mean, there's somebody that knows somebody that has what you need. So I would advise that you leverage your community of friends, of other founders, of maybe even your employees to, give you a list of investors. There's just somebody that knows what you need, that has access to that person that you need to be talking to. I think you should leverage that.
Awesome. Thank you very much. We have a question here from for Odunayo, and I think you've touched on this, is how did you manage the dips and low cash while trying to keep your business running?
Something very fascinating called bootstrapping. You put all of your own money into the business to make sure it doesn't die. If you're lucky, luck plays a big role in the success of startups, you don't have to do that again. But for many people, there are times when you will have to do it again, maybe a couple of times, right? And so the dips and lows from a cash standpoint, we were lucky. One, at the beginning, we were already running a separate business, so we just put the profits from that into starting PiggyVest. And two, we already had one support system who I think we share, Olumide Shoyombo, who was our first investor. So he'd invested in Push TV, and he just kind of continued to support us until today. At some point, he extended us like a 12 million naira loan. I'm not sure of the payback status of. So you need that. You need all of that in your corner. More than anything, you need to continue to drive towards sustainability. But I think Sheung mentioned it as well. A support system is very necessary. The journey is really lonely, is really long, and is really winding. And so if you can't front your business that money, you should be able to at least juggle your network to find people, someone who can front you some money to tide your business over. But that also requires that you are super critical with yourself. When your business is in a low, is it really in a low, or is that it? We always have to be able to answer that question succinctly and honestly before you bring other people into it, but yeah.
All right, thank you so much. I have a question here from Zainab, and this is for Dolapo. Considering the potential of non-tech but tech-enabled companies, such as, for example, law firms that are utilizing legal tech solutions, do you have any plans or interest in investing in such ventures? And I think you can speak broadly to sort of these tech-enabled, companies.
So yes, I think to answer your question, I don't think I quite understand the actual business you're talking about, but I can speak on tech-enabled businesses. That's something we have investments in. Oftentimes, even at pre-seed stage, the technology of a lot of our businesses are very nascent. They're not very strong. They might not even have tech really involved in the business. The main question is the business scalable? And I think that's the determining factor of that, yeah.
And very close to that, and this is for Odunayo, what does a company need to do to be VC backable?
So I think there's three things that determine a VC backable company, right? High growth like idea. Your problem has to be massively scalable. How many people are you serving? So there is an interesting thing in the different kinds of funding, right? VC funding is very different than PE funding. When a venture capitalist is investing in your business, they are looking towards a minimum of 10x returns. There was a time on social media where you were seeing people calling themselves 10x engineer, 10x this, 10x that. That's originated from the kind of returns that VC want to see. So your business, is it serving a market that will grow like to 100 million people? Is it serving a market that, well, those people being on your platform, does it translate to $100 million in revenue? So are you building a scalable problem in a scalable market to scalable profitability? That's it. So I don't think you need to do anything. You just have to be growing in multiples, right? When Dolakwa was talking about the year-on-year growth people would like to see, 50% year-on-year growth isn't just for any business. So again, there's different kinds of funding, and then you have to be able to figure out, what does my business do? Where do we fit? And are we VC backable? You have to answer those 3 questions.
All right, thank you so much. Moving quickly, Sheryl, you mentioned something about how you used your assets to be able to value, company. So I'll ask you this question because it's directed to you, but if any of the investors also want to answer, they can add. If you have no assets yet because you are pre-revenue, how do you value the company when your investor is asking the famous question, at what valuation?
I think I'll pass this question to Odu and Dolapo.
All right.
So there's industry benchmarks, right? If you're building in finance or ed tech, and you're building in a market, right? Africa, North America, Latin America. Before we drill down to your business as an individual business, we already have companies that have gone before. So nobody's really building anything in isolation anymore. So if you come as a pre-seed company, this is, I have an MVP, we have 500 users in Besa, we haven't made any money yet, but we will soon start charging. There is already a company that's similar to you, whose valuation we can quickly check to determine where you fall, and then we can then use the heuristics from your specific business to adjust upwards or downwards.
Awesome. Any additions?
I think she's summarized it very well. I think, just what the market is really what drives it. And just understanding that we're currently in a winter market. So even whether the market valuation we're using was from last year, we're definitely going to discount that down quite a bit.
Valuations are reducing too, people. It's not all bad news, Sha. I can see people shaking their heads. Sorry, apologies. This question is for you, Sheryl. Now, there are some, and I'm asking you because how did you bootstrap before you raised your first funding? So people are asking here that, what do I do if I don't have any money or anything? Like, how do I still go on before I can get that traction that is needed? Or is it because, people need to get traction? That's why we are not seeing a lot of female founders.
Okay, so for me, I didn't so when I launched Fez, I also had a side hustle. So I was working for another organization where I earned salary. So I was literally pouring out my salary into the business just to run it for the first year. We made a loss the first year, but from the second year, we started making profit, and I was able to pay myself back over a period of 1 year, another 12 months. Like, I gave 10 million naira to the business, then I started paying myself back. So it's okay for you to have a side hustle to fund your business. Yes, it's okay to have a side hustle to fund your main business and just bootstrap with that. And if you're able to raise money from family and friends, it's also, I think that's also another way. As long as they believe in what you're building and you have the integrity to return the money when you finally blow, I think it's all right to get money from people. So it's not you don't have to, and things are changing as well. VCs are still backing businesses, whether they have traction, they've gained traction or not. We have businesses in ideal stages that have been backed by world-class VCs. So I think it's important that, one, you believe in what you're building, understand it clearly, and you're able to communicate it. Two, it's okay if you don't have to get external, you don't have to focus on the business fully when you start. you can earn income somewhere else and pour it into the business just for the meantime.
All right, thank you so much. This question is going to Dolapo, and then Odunayo can answer. And I'm asking this question because we met a company quite similar. Why is there not a lot of eyes on other sectors? AKA, why are people only focusing on fintech? I'm a co-founder of a startup disrupting the natural gas sector by providing technical specialists for pipeline projects, all digital. I'm a woman. Basically, why are people not focusing on other sectors? Are you, as Ventures Platform, focusing on other sectors?
Hello? Yes. So we 100% are focusing on other sectors. We actually have a lot of initiatives this year to be able to find businesses in other sectors. And this is actually beneficial for a fund because you want to actually diversify your risk. So having all your companies in the financial technology space is not beneficial. So yeah, we are looking for other businesses that are actually building it in a VC backable way. And I think that's the main question mark, is if you're building a business, let's say in the beauty space, which is something I'm interested in, it's like you have to think around the size of the market. How big are you making it? Is your solution accessible to millions of people? Yeah.
All right. Thank you so much. And then we'll take one final question. What if you do not raise the money that you wanted to go out and raise, right? What does it mean? Because you said some people said no to you, and I'm throwing this question out so anybody can answer. When you get all no's, what does it mean for you as an entrepreneur? Do you just close shop and go or what do you do? Any one of you can take this question.
Can start with this, and I think Oare, who was on the panel before us, mentioned that she was fundraising for 2 years and got no leads. And then she spoke to someone, she spoke to an advisor that helped her think through her business, think through her pitch deck, and immediately after that, she started seeing leads. And I think it's important, if you're in that situation, to do a reality check and actually check, is there anything that they're saying that I'm not seeing? I often, we try and give feedback as much as possible when we see companies. So I think it's important to always ask VCs, why are you saying no? And if you can give me, a few minutes of your time to actually explain or speak to friends that have either raised money to get feedback, to see if you can tweak your business model or see the market in a different way that you're not seeing it. So I'll speak around that and maybe someone can speak on something else.
Just one more.
I'll just add to what Dolapo already said, and it's around the feedback. It's very important that as founders, we are open-minded, and we don't take feedback as a death sentence. One of the things that Odun did for us was, we had reached out to her, and I was so confident that she was going to buy our business model. But she came back to us 3 weeks or 2 weeks after with a very detailed feedback. We are not going to invest in you now, and she gave us 6 reasons why they were not, about 6 reasons why they were not going to invest. And it made sense. So I just went back, took those feedback, and met with the team, crafted something, and we took it as, it was feedback. It wasn't she was not attacking the business. So if people say no to you as a founder, I think it's an opportunity for you to go back and reflect on what you're building and maybe make some adjustments.
All right, we have tons of questions, and I'm sorry that I cannot take all of them, but some of us are still here, and my colleagues wearing the T-shirts are still around, so you can meet any of them and also ask more questions. But I'd like us to give them a round of applause, please. Thank you so much, Dolapo, Odunayo, Shewo. If we can go next, there is a feedback. If you go next, please. Just very quickly, sorry. We'd like you to share your feedback on how this session went so we can improve. We're always collecting feedback. That's the way we also improve. So please scan the code and share your feedback. But in the meantime, please let's take a quick picture and give them a round of applause.
Thank you very much.